The stochastic indicator, which is also referred to as a stochastic oscillator, is a momentum indicator that tells you the momentum of price. The oscillator works on the theory that, during an uptrend, prices should stay equal to or rise above the previous closing price, whereas in a downtrend prices would likely remain equal to or fall below the previous closing price. It might help you to liken the movement of price to the movement of a coin when you toss it in the air. When you toss a coin, it reaches the top, and before coming down, it would have to slow down. Similarly, before a price changes direction and reverses, it will normally slow down and lose its momentum. You can then be on the lookout for these momentum shifts in order to trade reversals such as bounces. When you turn on the stochastic indicator on your trading platform, it often turns up as a window on the bottom half of the screen under your price chart, as shown in the chart. As you can see, this indicator consists of two lines, blue and orange. Here is what they represent. Blue line, %K, the main line, and orange line, %D, a moving average of %K. K, which is the main blue line, is calculated with this formula on the screen. Don't worry, you won't have to calculate K yourself. This is usually done for you automatically by whatever trading platform you're using. However, it's good to know how these numbers are being generated so you're more well informed. Now, let's dive a little deeper into the stochastic indicator and understand how it can help you in developing your trading strategies. The stochastic indicator is mainly affected by three variables, namely the K periods, D periods, and how smooth the K period is. Here we'll do a basic explanation of these variables. Firstly, we have the K period. This is the number of periods used in the stochastic calculation. Let's take a look at how we input this value into the settings for the indicator. If the 21 period is selected on an hourly chart, it means the data from the past 21 hours are taken into consideration when calculating the value of K. This is the number of periods when calculating D, the moving average of K period. This number controls the internal smoothing of %K period. The smaller the value, the faster the stochastic. For example, if the setting of the period is 1, that's considered a fast stochastic. Conversely, if the setting is raised to 3, it's considered a slow stochastic. You can see how it changes the stochastics by testing it out on TradingView. Now, how do you use the stochastic oscillator then? You should view the stochastic as contained within a band, which is made up of two lines above and below the moving averages. This is commonly known as the upper and lower band, which are set at 80 and 20 respectively. You can see the band highlighted in the picture. This band allows you to deduce whether the price is currently at a level that's deemed to be overbought or oversold. Simply put, if price is above the upper band, the market is deemed to be in an overbought area, thus traders would be looking to sell and take a short position. On the other hand, if price is below the lower band, it would mean that markets are currently in an oversold area, thus traders would be looking to buy and take a long position. The standard 80-20 range is commonly used by a large majority of traders as the upper and lower band. Traders following this theory will buy once the stochastic dips below 20% and sell once the stochastic rises above 80%. Beyond this, the stochastic indicator can be useful in helping us to determine a few important levels and opportunities that can enhance your trading strategies. When used correctly, it can help you identify the following: hidden support and resistance levels, horizontal; hidden support and resistance levels, diagonal; hidden breakout levels, bearish divergence reversals, and bullish divergence reversals. Once you're aware of these levels, you can then fine-tune your trading strategies and make better trading decisions. For example, knowing the reversals can help you to trade bounces, while the hidden support and resistance levels can help you to identify good stop loss and take profit levels. Stochastic indicators can be fine-tuned to help you to trade more profitably. This can come in the form of better settings for the oscillator or better strategies with which you can use the indicator for. Many traders are unsure of the best settings they should set their stochastic indicators to. A lot of people prefer a fast stochastic because it moves faster and therefore presents more trading opportunities. However, a slow stochastic may be more suitable to avoid poor trades. It can also be good to cycle between a range of periods, instead of just sticking to the standard period of 5. For example, you can check a range of periods, mainly 13, 21, 34 and 55. It's common for many traders to use the industry standard of 20% and 80% as the bands on the stochastic indicator. While this can be done, a much better option is to analyze the stochastic indicator and look for hidden support and resistance levels. Let's have a look at how this can be done. From the chart we can see that there is a stronger support level at 7% instead of the usual 20% that the crowd is following. This is because we can see that the market has bounced off from the 7% level much more than the 20%. From this we can tell there's a good entry level here that we can use. Did you notice how stochastic bounced off our support level perfectly and price also did the same? This shows us that hidden levels tend to be stronger if we're able to find them instead of just sticking to 20% support that the crowd follows. If you found this video helpful, give it a like, subscribe to the channel, and turn on the bell so you don't miss the next trading tips. And if you're ready to take your trading seriously, check the link in the description.